Yeah, thanks, Kevin. Good evening to everybody. Thank you for dropping by on a Friday evening. And I think most of you have gone through a hectic week of attending all the seminars. So actually the reason why we came out to share a bit on investing is because I have lots of friends and some relatives. They always ask me how do we actually invest money, and they are pretty confused because there are lots of information out there, and if you go through even if you go through the papers and all that, I do not blame most investors for being confused. So I think I hope to share with you our story of how we manage to how to cut out all the noise and really focus on the process of investing. So this is the usual disclaimer. The contents are purely for entertainment. Okay, so I think investing, there's a lot of hocus pocus out there. So whether hocus pocus wins or science wins, it depends on how you improve your process and what you're going to do for your own implementation after our sharing with you. This one is a summary of what we are talking. If you cannot remember anything, just remember this slide. The main failing for us as investors is because of our need for social approval, meaning that human beings, they live in a social setting, so that is the cause of their failings as an investor. So if you want to invest well, you need to get some Jaguar genes transplanted into you. Then you'll be able to do a better job. The Jaguar is a complete killer. It can swim, it can climb trees, and it is solitary. It hunts alone. So if you want a model for investing, you have to be a Jaguar and not monkey around with your investing. So these are some of the questions that throughout my career people will ask me. Where do you think the market is heading? What do you think of Olam? Is this a good time to invest? How about Iskandar property? If Temasek is in it, it should be okay. It won't collapse. What is the impact of cooling measures? QE4, which sectors you think is going to do well? What about the bird flu? How about North Korea? So I get asked all these questions, for the last 10, 15 years. And during the initial part of my career, I was very, very frightened when people asked me these questions as a fund manager, because I don't know. All these are the noise that I'm talking about. I really don't know, and I can't admit openly that I don't know, because I'm supposed to know such things. But the truth is I don't. So after a while, having gained confidence from my own investment process and for the fund that I manage, I dare to call all this hocus pocus investing. Now I don't say I don't know, I say all this is nonsense, trying to answer all these questions. Okay, this is one thing that sometimes make me very frustrated and very angry. Because people will tell me all sorts of things. They bought this, they sold that, they made so much money last week, they made so much money last year, and so on. And I ask them, do you track your return? Do you know how much you have made or lost during the last 5 years, 10 years? Do you actually track your return? Do you know your return or not? So if I ask you, for the last 10 years, you have been managing money, what is your rate of return? Anybody can tell me? So they don't track their return. They are opportunistic. So now you come here, right? What can I do for you? What kind of returns you can get after 10 years, 15 years implementing this process? Anybody want to tell me what return they think is a good return? Okay, never mind. So most people that I meet, they will have this, you know. Assuming if you are a student or you have started out working or you are a retiree, most of you here probably will have a portfolio that is like that. Unit trust. Okay, unit trust, you lose out a lot in fees and underperformance. I think if you all read the literature, you know that most managers will not perform as well as the index. Okay, this one even more dangerous, flavor of the month unit trust. So they will launch this type of unit trust when it's a bull market in a certain country, whether is it BRIC last time, or whether is it the China fund last time. After it has performed very well, they will launch this kind of unit trust. Or when I remember in year 1999, they launched the .com unit trust. Everybody was buying it. They bought it at $1 and it ended up at 15 cents. That is a .com unit trust. So that is what I call the flavor of the month unit trust. You buy this, surely finish one, I tell you. Then after that, investment-linked products. Okay lah, this one, if you can't save money, you spend all your money, it's better that you at least tie up your money somewhere. Then, fixed deposits, bonds, flavor of the year investing, Iskandar project. Land banking, bird's nest house in Sabah. Somebody was telling me that he did due diligence on seaweed farming in Sabah, okay? So, these are the ideas. Your friend's business idea, your own business idea. I mean, for most of us, I know some of you are businessmen here, so you are doing well in your investing, so that's fine. But for most of us working folks, we will have all this. So will all this bring you towards your saving for your retirement? So this is the result. After 10 years, right, you earn about 4% a year, not too bad lah. Flavor of the month, probably down 20%. Investment link, 4%. Fixed deposits, 1%. Bonds, 5%. Iskandar project, okay, maybe you are lucky, you made 20%. Bird's nest house in Sabah, minus 100%. Your friend's business idea, not only you lost your money, he had to borrow some more from you to try to recover the loss. So that's minus 150%. Then your own business idea, not too bad, 0%, didn't make any money, just wasted your time. So you have all this, what is going to happen? Your average return is 3%. So for most people, these are the returns that they are clocking, 3% a year for your entire portfolio. So like that, how are you going to grow your money? You cannot even beat the inflation. This one is called the Noah's Ark of investing, one of each animal. So you get this. Then what is the result? Okay, at 100,000, 3% per annum. I think this one available to most working folks after a few years or after many years of working, you should have this amount. After year 30 is 242,000. Like that, how are you going to fund your retirement? Very hard, I think. But that's the situation that I see. So it means that you have to do things quite differently, right? Okay, to summarize, this is called hocus pocus investing. What is the next big thing? Listen to news, forecasting, economists, pundits, government officials, gurus, and charlatans. This is hocus pocus. Hot investment. Then the question is always, is this a good time to, don't know what? Market timing. Hocus pocus investing, you're always afraid. Like you invest in some of these property thing, right? You don't know when the flood is going to run away your money. You don't know when it's going to blow up. So you're always afraid. Always on one's toes and always opportunistic. So this will get most people nowhere. But if you do the so-called proper approach, I mean I use scientific approach, if not nobody will come and listen. It will be process-driven. It is disciplined. It's backed by historical results and studies. It's under no pressure. It's fundamentally driven. It requires you to understand some basic financial mathematics. It's proven and grounded. So is there such an approach? You know, when I started my career long time ago, I got confused, by all this noise and made all these mistakes. Until one day, I found this approach. So why am I sharing this approach with you all? I hope that some of you will take it and use it for yourself. But most of the time, I think our genetics don't allow us to implement such an approach. So you need to get some Jaguar genes transplanted. So this is our objective, to do 15% per year. Can we do 15%? 100,000, after year 5, 200,000, year 10, 400,000, year 15, 800,000, year 20, 1.6 million, year 30, 6.6 million. I don't think I will get to see this because by then, money won't matter anymore after year 30. So this means doubling in 5 years, 4-fold in 10 years, 16-fold in 20 years. Okay, some of you will say that this one is too slow. This one is really too slow. 15% is too slow. There's no way I can make 15% in 1 week. So that one, I think those who can make 15% in 1 week, good night. I think no need to continue to listen because I don't think I can do more than 15% a year. Those who can do more than 15%, maybe, you can tell us how to do that. So I show you some evidence of senior value investors. I just show you some guys who have been doing this for a long time. Then we see what we can learn from them. Okay, this guy, he just died 2 years ago, 90 over years old. His name is Walter Schloss. He started his career sitting side by side with Warren Buffett. But Warren Buffett is the famous man, but not him. Because he is of low profile. He's not Warren Buffett, but everybody knows Warren Buffett. The good thing is that most people will follow Warren Buffett approach. They do not know. They seldom hear of him. Anybody heard of him? Okay, great. So this is his. First, you must look at all these great investors. Then you must see what kind of returns they have clocked. Then after that, you try to see how they do that. To summarize Walter Schloss, 1956 to 1984, they show you the track record line by line. They show you the performance line by line. So there's no bluffing, there's no cheating. All these numbers are out in the open. So for 28 years, he grew money at a rate of 16.1% a year. So which means if you have even invested 100,000 with him in 1956, of course it's a very long wait, but there's no such thing as fast money. This is slow money. But still, 100,000 to 6.5 million. This is Walter Schloss. Walter Schloss, he didn't even go to university. He worked with Buffett, and their teacher is this guy called Benjamin Graham. So they sat side by side, and he looked through the stock list one by one, painstakingly. And then he bought when he felt that it was undervalued. So he didn't even play golf with management, no management or whatever. He just did it independently. So this one, another guy, they set up a partnership called Brown, Christopher Brown. So his return from 1968 to 1983, 15 years, is 16.0% per annum, which translates to 100,000 to 926,000. So this is Christopher Brown, another value investor. Again, the results are line by line, and the results are public data. This one, a famous guy, Charlie Munger. He's Warren Buffett's partner. I think a lot of people know him by now. Those Warren Buffett followers will know him by now. So what is his rate of return? 1962 to 1975, 13.7% per annum. Again, all the results are tabulated yearly. So the greatest, okay, I go back to here. I just want to tell you something. Last time in the early part of my career, right, my wife, she always go to the investment seminar, like this type, So I always ask her, I say, you go for all these seminars, do you know the person who is talking in a seminar or the person who is selling you a course? Do you know his track record? Did anybody in the audience ask, what is this person's track record? So she said, no, never asked. Then I asked, did anyone ask? Then no, nobody asked. Then how do you know what he's telling you can be useful? Maybe his track record is 3% a year or minus 10% a year. So then why will you listen to a person who is generating minus 10% a year or taking a course that guy is generating 3% a year? You wouldn't want to do that. Then why you attend the seminar? I always ask her this question. After a while, I gave up, I surrender. So this guy is the greatest compounder of all, Warren Buffett. Anybody knows what kind of rates of return he can get a year? Yeah? Okay, 20%. Anybody? So the answer is actually 20%, 19.8%. So if you have invested in Warren Buffett, 19.8%, over a period of 47 years, he grew 100,000 to 486 million. That is almost $500 million. That is if you can grow money at 19.8% per year. The funny thing is that all these course providers or whoever, they always tell that they can make 20, 30% a year. You read the newspaper, Me and My Money, all these guys are making 20, 30% a year. Some of them making 20, 30% a month. How can that be? How can that be? So that's why as an investor, you must know your numbers. If you know your numbers, then you know somebody is conning you or not telling you the truth. Geneva Gold is 30% a year. 2% compounded for 12 months is 27 point something percent, almost 30%. So they are actually better than Warren Buffett, So if you do not know your numbers, then you will buy these kind of products. Okay, this guy is a famous investor. I just share with you some stories. I don't know him. He's definitely better than all of us here because he's a billionaire. He cycles his daughter to school on a tricycle. he talks about commodities and promotes it. He has never disclosed his track record. Then he said that he's too rich to be bothered about keeping track of his wealth, so he don't disclose his track record. So if you listen to him, he always asks you buy commodities, buy gold and that. Recently, gold price came down, then he said don't buy because he's waiting for it to go lower. So my question is, yeah, he's a billionaire, but what can you learn from him if he don't show his line-by-line record? So can you use his advice? No. Can you put it in a process? No. So what is it? It's a hocus pocus. Can't do anything with it. Okay, this one is a maths question. What is wrong with this advertisement? This is a maths question. So anybody can tell me what's wrong with this question, with this advertisement? So if you know numbers, right, straight away you know that this one is a... Okay, I'll show you. How to turn $2,000 into $7,000 in 21 days. So they can make 240% in 21 days, you know. Then after that, you look, they can make 41% in 1 day, 31% in 2 days, 47.2% in 1 day. So if you know maths, right, what you do is this. 240% in 21 days, right? I give them the benefit of the doubt. So I use 240% per year instead of 240% in 21 days. I just use per year lah, okay? I don't believe you. Never mind, we use per year. So if you invest $10,000, after 20 years, I'm not sure what is this number, no? That means these people, you know what they can do or not? They can do this, you know? They can buy this. So I think you need to be aware of, learn some mathematics lah. Okay, now we have covered the old guys. Now evidence from statistical studies. So there seems to be some kind of science in this. Just now, those are the older folks. They have invested money. I show you their track record. But maybe they were very lucky or they were very fortunate. Right? I can just pick a few heroes and show you. What about those fellows who lost the money and yeah. Okay. This one is need some explanation. How many of you do not know what is PE? How many of you know what is PE? Okay. First, for the benefit, I will very quickly explain this. So imagine your friend, his name is Ang. He runs a Ang coffee shop. Year 1, year 2, year 3. This is his record. His income in year 1 is 100,000, year 2, 105,000, year 3, 100,000. So not bad lah. Every year he made about 100,000. So the question is, how much would you pay for this business? Anybody? How much will you pay for this business? How much will you pay for this business? 100K? 500? Then how about you? How much will you pay for this business? 400. So the range is, he said 400, then 500, then 100. So what does that mean? So you pay 100,000 means you really hardcore value investor. You pay 100,000, you get back 100,000 in 1 year. So this one is super kiasu, super stingy, and super low balling. So like that, I also want, if you can find a PE of 1. Okay, to summarize, you pay 500K, is a PE of 5 times. 500K you pay, 100K your earnings or your income, PE of 5. So you pay 500,000 for 100,000, that is PE of 5. If you are very kiasu, you pay 100,000, that's a PE of 1. 100,000 divided by 100,000 is 1. So the lower you pay, the more, the better for you, right? Okay. So very quickly, you pay 1 million, So 1 million divided by 100K is 10 times. So this is PE of 10. So you pay him 1 million, you get back 100,000. 1 million divided by 100 is 10 times. So most of the blue chips in Singapore, they are selling at maybe 15 times, 17 times, 20 times PE. The blue chips, all the SGX and all that, they are selling at high multiples. So we don't want to, as a value investor, you don't want to pay a high multiple. Okay. Just now I explained to you PE. Now I just show you this for fun because I say scientific, so I need to show some periodic table. Then I went to read up on periodic table because I vaguely remember this. I remember that if you, based on the atomic number, if you go down, right, the metal become more reactive. Then as you go across the table, the metal will become non-metal, then after that end up as inert gas. Then some of these will be neither here nor there, silicon, carbon and all that. It's neither here nor there. No? So the periodic table is very interesting because based on where the atomic number, you can predict the characteristic of that element. Okay, so periodic table is science, right? Okay, this is the periodic table of investing. So if you want to invest, you look at the periodic table of investing. So I explain this. This one hard to explain, but I try. Investment results of New York Stock Exchange, 1966 to 1984, based on the PE ratio. So this is a table, but let me explain. I try. So from 1966 to 1984, that's a long period of time. So you have all the stocks in the stock exchange. Then I break the stocks in the stock exchange, all of them. For example, in Singapore, there are 700 over stocks. So I break them into 10 buckets. So I take the first bucket I put here. I put all the lowest PE stock. Then after that, I take the slightly higher PE and put into this bucket. Then I take the slightly higher, even higher PE and put into this bucket. And so on. So the last bucket here would be the highest PE stocks. So out of the 700 stocks in SGX, I break it down, I will have 70 of the lowest PE in the first bucket, second bucket, slightly higher, and right at the 10 bucket, I have the highest PE stocks. So I broke them into buckets. Then after that, I start doing that in 1966. Then after 1 year, right, I assume that I invested in the first bucket, second bucket, third bucket, fourth bucket, fifth bucket, and 10 bucket. I make the investment in these 10 buckets. Then at the end of 1966, 1967, the prices will have moved, right? So again, I sort them, and I buy them again. I keep repeating this, I buy at the beginning of the year, after sorting, at the end of the year, I sell, I sort again, I buy again. So even if my IQ is 0, I can do this. That means it don't require a high IQ. That's why I like this method. Because I have a low IQ, so I need this kind of method. So the 10 buckets of performance, you look. The lowest PE ratio, the annualized return is 14.08%. Then the second, slightly higher PE, the second bucket, the first bucket was here, is 14%. Second bucket here, 13.8%. 10.9, 10.29, 9.2, 6.43, 7, 5.57. So the highest bucket, the highest PE, return 5.58% and 5.5%. So can you see that the numbers, right, are almost consistently decreasing? So this thing is like the periodic table. From metal to non-metal to gas and all that. So some of my friends will say, hey, I only buy blue chips. Because blue chips, they will last forever, they won't die, I can get my dividends and all that. Okay, it's fine, you like blue chips, it's perfectly fine. You just buy it. But blue chips are usually High PE, right? So what happens to the high PE? You get this return, 5.58, 5.50. Then plus some dividends, okay lah, not bad. So you buy the unit trust and all that, you look at their stock list, all blue chips. So you get this result. But now, we don't want to get this result. We don't want to get the 3-4% return, 5% return. We don't want, that's why we want more. So you want more, you must do this. It's a big difference, you know. You see, during 1966 to 1984, this one is quite long, almost 30 years. $1 become $12. Then you invest in this method, $1 become $2.80. It's a huge difference. It's like a four-fold difference, you know. Okay, that is the US market. What about the local market? I think you all know about this author, right? Tay Hui Ling. How many of you all know her or read about her? How many of you all practice her ways of investing? So she's a very good journalist. Whatever that she writes, she tries to help people. And she really writes sense. And I think if you are starting to invest, you should read her articles or read her books. That will put you in a good footing to differentiate what is good and what is bad and what is normal. So she did some tests. I show you that is the New York Stock Exchange. Now she did a test on the Singapore market using the same principles. So performance of basket of stocks rank based on their PEs. So again, the 10 buckets 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Then from 1990 to 2012. So she did the same thing, sort them by PE, bucket 1, bucket 2, and do the test from 1990 to 2012. That is 22 years. So what is the upshot? Upshot is this. This blue line, this is the lowest PE one, you know. You see the big difference between the lowest PE and the rest? So the annualized return is 14.6% a year. So if you do this, 1990, do until 2002, is 14.6%. It means that $10,000 invested in 1990 would amount to $200,000 in 2012. So this one is science. It's statistically tested. You may ask, why like that? Why don't the fund manager implement this and give me this 15% return? Why? Why don't the fund manager implement this? First, if you buy low PE stock, if you are an investor, you buy the low PE stock, you'll be scared, you know, because it's not DBS, it's not Singtel, it's not StarHub. You buy low PE stock, who dare to buy low PE stock? If you buy low PE stock, and if something goes wrong, you are going to be fired. So the fund manager will never do that for you. Because he has to write a very long report to justify why he is buying this low PE stock. You think about it, if I work in a bank, why would I want to write this report? It's so troublesome. If something goes wrong, then how? I still need to feed my family and all that. So they'll buy the normal. They buy, what, Olam? Everyone buy Olam. What's wrong? So he crashed, too bad, the other fund manager also buy. I buy, it's okay. So if you buy unit trust and all that, that is the problem. This is called the agency problem, meaning that they are there, their first priority is to protect their jobs, second priority is to get the bonus. Their priority is not to make money for the client. So there's one fund manager that implements this. That's us, because we are not afraid of being fired. Okay. So I think some of you who have been doing investing, you will know what is PE. Another study is the price to book ratio. Okay, price to book is another good indicator that you can use to get your double-digit return. So I explain a bit what is price to book. People who buy the price to book are not interested to know what is the earnings. They are even more kiasu. Don't tell me how much your business is going to earn. I'm not interested. I just want to know if I liquidate your business, I sell everything, how much money I'm going to get back. So in this coffee shop example, the coffee shop that you're going to buy, the cash is 100,000, the inventory is 100,000, the receivables 100,000. Altogether, 300,000 current asset. Long-term asset, 200,000. So altogether, the asset is 500,000. So I minus out the debt, 200,000. So altogether, if I liquidate this business, I close shop, I'm going to get back 300,000. So if I buy this business, I close it, I'm going to get back 300,000. So how much will you pay for this business? Okay, so he paid 300,000. So not bad, he's quite fair. For me, as a value investor, we will not pay 300,000. We will only pay 150,000. Sometimes in the stock market, you can even buy companies that are below the cash, That means it's like you go to a company, you see 1 million there, but you can buy the company for 500,000. Things like that happen in the stock market because, back to the slide, I showed you the monkeys, right? They just simply buy and sell. They don't even know what's happening. So the lower the price to book you pay is better. For example, right, you pay 1 million for just now that business. 1 million divided by 300,000, based on what you get back, you pay 1 million, you get back 300,000, that's 3.3 times. Not so clever. So you pay 300,000 and you get back 300,000, the price to book is 1. So not too bad. So our friend there, not too bad. So as an investor, you want to do this. 200,000 divided by 300, you pay 200,000. So you are getting a price to book of 0.66. So which means that the lower the price to book, the better the bargain. Okay, so this is a very, another study. Well, all these tables, I think, very heavy going on Friday evening. Okay, but the gist of it is that when you test the high price to book, again, the decile, the 10 buckets are 1 to 10. The lowest price to book will give you an average return of 19.8%. Whereas it will go down as you pay more. 19, 18, 16, 15, 14, 12, 9. So again, you can see it's like a periodic table. So the moral of the story is the less you pay, the better return you are going to get. The PE also the same. So price to book and PE are two important indicators of your portfolio performance. Actually, I don't know whether I'm talking to myself because all this very, all this table. Anybody want to ask any question? I'm not sure whether I'm talking. Anybody? Yeah. CAGR is a annualized growth rate, compounded annualized growth rate, if I can remember. I just know it's CAGR. That means, what is your annualized return every year? That is a CAGR. Huh? How much? That one is the, that is a net tangible asset. Maybe you are trying to say. Yeah. 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 that's a very good question. Because what he's saying is that if you buy those low PE, the company close shop, then your heart cannot take it, no. This stupid fella say he got the scientific approach, then I buy the low PE one, then the company close shop. Then how? Okay. I know. It's included inside. But I know your question. Your question is low PE stocks are very dangerous. After that, I will review the Kung Fu manual, the last stage of the Kung Fu manual. Okay. So 19.8%. I think all this some of you already know, but later I'll talk about the implementation. This guy, another one, Pharma and French. You go and look it out. I won't go through it. Another table, so it doesn't matter. Just know that there are studies done, look it up and study it carefully. This one is price to book and small cap, that means small companies. To get that means from this table, you want to get the highest return, right? You must invest in small company and very low price to book. So you get the average of 23%. Again, this table is like the periodic table. Amazing, right? 1963 to 1990. The one who did this, he won a Nobel Prize. But nobody want to read all these papers, too boring. Yes? Equal weighted, 10,000, 10,000. Yes, all equal weighted. Meaning that what she's asking is, you find these all the low PE stocks. So how do you allocate your money? So you just allocate equally. Just say you got 100,000 and you find this, so you just allocate equally. Okay, now I think I show you the studies. You can go back and find out more. So why investors lose money? Market timing. Now I just share some of my experience. Not that I'm laughing at people or what. Just share some experience. Market timing. So this is the ST index from 1987 to 2013. 1987 go up and down. Then Asian crisis here. Then this one is the Lehman crisis, financial crisis. So most people, they'll do this, At the start, they won't invest here because too scary. So here they invest 10,000. Now I tell you why a lot of investors fail. So here they invest $10,000 while the market is going up. Then after that they feel quite happy, right? Because it went up, right? So at this point they invest $50,000. Because market went up, you made money already, what? So what do? You take out 50,000. At first the 10,000 is to try. After that you put 50,000. Then after that, wow, go up some more, invest 100,000. So this is why you lose money. Then after that, what happened? Cut loss. Because market going down, the world is going to end, everyone is going to die, so better cut loss and take back the money. So you lose money because your 10,000, when you cut loss here, maybe you are break even. But this 250,000 already suffered a huge drop, That's the first problem with investor. So if you know anything, if you are working, earning a salary, what you do is just go and buy every month or every quarter. Don't go and mess around and do the market timing. Okay, another reason why investors lose money is because they think that they are Warren Buffett. This one was when I was when I was 30 years old. So I read for you. This stupid fella thinks he's Warren Buffett. So that's why they lose money. Last time I thought I was Warren Buffett. Then when I lost a lot of money, then I know I'm not. Okay, I explain to you why. Everybody know Warren Buffett approach. So what Warren, I just show you something very interesting. So everybody go and follow Warren Buffett. Luckily, nobody follow Walter Schloss. Then I'll be out of business. if they follow Walter Schloss. Walter Schloss, low IQ. Warren Buffett, high IQ. So if you learn the Warren Buffett approach, what is rule number 1? Buy good quality companies with high ROE. Make sure they have a sustainable competitive advantage. Nobody can penetrate their business. Make sure they can raise prices whenever that they like. Make sure that everybody drink their product. Make sure that everybody use their product. Make sure there's a competitive mode. Make sure there's huge net margins and so on. That's the Warren Buffett approach. Now I explain to you why you use Warren Buffett approach. You are going to kena big time, no? Unless, of course, you are Warren Buffett or you are very talented. Show you. Okay, another chart. So now, this chart, you take the whole universe of company, S&P 500. Now you easier, you break them into 5 buckets. First bucket, you put all the high ROE companies, good quality companies, competitive mode, blah, blah, blah. Put into the first bucket, highest ROE. Then after that, the second bucket, put the second highest. Third bucket, third one. Then the last bucket, you put all the doggies, those companies are struggling, don't know whether can make money or not, maybe will die. So if you are Warren Buffett, you will invest in that very first bucket. Okay, let me show you what happened. This is the S&P 500. This is year 0, year 1, year 2, year 3, year 4, year 5. This is the ROE. So the high ROE will be in this bucket. The highest bucket, 25% ROE. Then not so high, and so on. Here will be just barely surviving. So you invest in high ROE company, for example, like Apple. Then year 1, ROE will drop. Year 2, drop further. Year 3, drop some more. Remember, this one don't apply to one company. This one applies to a group of companies that are in high ROE. So statistically, you are betting against the odds. When you buy high ROE, like Warren Buffett, you expect it to go higher and higher and higher and higher, and you will make a lot of money. But the truth is that the odds are against you, because when it goes down, you are going to lose one huge chunk of your money. So that's the mistake that most people make. And this guy. So, okay, wait, let me explain one more part. So what happens if you don't want to be Warren Buffett? You surrender. You say, I will invest in low ROE companies. Now this part, management, they are very scared, no? Because they are losing money. They stop playing their golf. They stop wasting time anymore. No? Then they work very hard. Then after that, when the ROE from almost 0% go to 5%, they report a profit. What's going to happen to the share price? It's going to go up. It's like if you are the last student in the class, the only way is for you to improve. But if you are the top student in the class, you drop from first to second, you are finished, Your share price will totally be annihilated. So this is one thing I learned. So some suggestions for implementation or how to achieve double-digit returns. Okay, you invest in ETF. Every month you invest. You will get about 7 or 8% over the next 10, 15 years. So the ETF is the first option. But the problem with investing in ETF, first, you must admit you are stupid. So if I admit I'm quite stupid, then I will invest in ETF. But human beings don't want to do that. I mean, in the earlier part of my career, I should have invested in ETF. But I didn't. I thought I was Warren Buffett, so I lost quite a bit of money. But I should have started ETFs in the beginning. So if you have no time, you need to concentrate on your job or whatever, just invest in an ETF regularly, monthly, quarterly, and then you are going to clock your 7, 8% returns. So do not time the market. Keep investing and stay invested. This helps you to win 50% of the battle. Don't market time. Then the second, buy what has been proven. Low PE, low price to book, high dividend yield. This helps you to win another 50% of the battle. So one workable strategy is you buy dividend yielding stocks. Just buy and buy and buy. Every quarter you buy, every month you buy, every year you buy. Just keep buying. And the dividend money is not for shopping, it's for reinvestment. Unless, of course, you are a retiree, you need income. So you need to track and monitor and review your performance. Number 4, maintain a diversified portfolio of at least 50 stocks. So this one is the page from the secret manual. No? It looks very normal, but this is the secret of investing. No? I explain why. For example, you buy low PE stocks, it's very scary. Some of them close shop, then you lost money. You only got a few stocks in your portfolio. Every day you think about it. So for these statistical studies to work, you must so-called have quite a number of them. That's called the normal distribution. For the normal distribution to take place, you need at least 30. So when you employ the low PE, low price to book, high dividend yield strategy, make sure you have at least, make sure you have at least 30. If you got more money, go up to 50. So that is important, I think. That is actually very important. That protects the investor from himself. Then if you invest in other markets, don't just stick with Singapore. If you have surpluses every month and don't need the money for at least 5 years, don't even bother with bonds. Just maintain an all-equity portfolio. This one is quite radical, but we want to achieve 15% rate of return, so this is roughly what you need to do. Okay, this is advertisement time. This is a firm that I work for, Aggregate Asset Management. So we manage money using some of these principles. And I think the key principle is this, alignment of client interest. So if you go out there, my friends go out there, they buy products, they are hit with the sales charge, management fee and everything. So they just make money off the investors. I mean, not bad-mouthing anybody, but they just make money off the bigger they grow their fund size, the better. They charge more fees, more management fees, and so on. Ours is different. Ours, I think, is very rare. It's the first in... it takes a very brave or very stupid people to do something like that. That means we only charge a fee when we have made money for the investor. The full amount is invested, and when the investor makes money, then only we charge a fee. So it's a completely different way of doing things. Yeah, hand it to Kevin. Say again. Yeah, so I think we are not exactly here to promote our fund. We are here to talk about, I think if you want to know more, you can speak to us separately, or you can visit our website. I think this one is more for to talk about the process. If you have any questions, maybe later.
Thank you very much, Eric. When we started this fund, actually, a few months back, people was asking us, is it true, is it possible to run something like this? Our answer to them is actually, there are only two possibilities. Number one, either we are very mad, or number two, we really know what we are doing. Okay. So just for your info, the fund currently has, we practice what Eric has shared with you. We currently hold about 105 stocks in our portfolio, in a small portfolio. We hold 105 stocks. Our average dividend income from the whole portfolio is about 4 point something %. our average price to book ratio of the whole portfolio is about 0.66, 0.6, yeah. So it's below 1 for our price to book ratio of the whole portfolio. So that's roughly to show you that actually we practice what we say, okay? If you have time to drop by our office to discuss a bit more, we can show you the details. Yeah, I just need your cooperation for tonight. It's getting late. In your envelope, brown envelope there, we have a small little first sheet of paper to just give us a feedback. Can you help us fill up the first part of it and pass it to us on the way out? And before we move to the next segment, then we'll actually, in the interest of time, probably we can take up maybe about 3 or 4 questions. Eric, we'll take up about 3 or 4 questions. So anyone has got questions, the mics are at the side there.
What is your track record?
What's our track record? Okay. Okay.
Last time you can Google a bit about us. Last time I worked in this company called Yeoman Capital Management. So that was my old company. The track record there is audited. I was there for 8.5 years. So during that period, I managed the Australian pension fund. So our track record for that period is about, after fees, is about 13% for 8.5 years. So that's my track record. Then I left the company 3 years ago. So I left because, you know, my daughter, I think just now Kevin mentioned, I homeschool my kids. So my elder daughter was in primary, during the time she was in primary school. So I decided to spend more time with the kids, so I quitted my job at Yeoman Capital. I was a partner in Yeoman Capital. I hold 25% shares in a company. So when I joined the company had a fund size of about 15 million. Then during the 8.5 years, we grew it to 300 over million. And our returns on the average is 13% a year. You can check out the website. And if you want to do further due diligence, I can show you the more details on that.
Sorry, maybe we can restrict the questions to more general investment principles and concepts, because we are actually not be able to explain the detail of our products to you today. So feel free to contact us for the detail of what we are running. But maybe more for discussion purpose, the investment principles and concepts, anything that you don't agree with or you have any ideas. The question is, how do you avoid the value trap?
Yeah, what he's asking is that you buy the low PE stock, it will blow up, or low price to book stock, it will blow up. That means you get to zero. So how do you avoid that? In short, you can't avoid that. It will happen. But as a portfolio basis, because when you are working in that decile, the low PE decile, the law of large numbers work. It's like you are going for a war, you send a battalion. 1 or 2 soldiers get killed. That's too bad, but you win the war. And the war is that you are going to get your 15% returns by employing this strategy. But this strategy is hard because you have to buy a bunch of these stocks that looks scary. So I give you an example of what I mean by scary. You know, when Apple lost Steve Jobs, it went down to like less than $10. Then at the same time, you had Palm Pilot, you know. I'm just talking about US stock. I think more people will be familiar. So you had the Palm. So if you bought those stocks, your Palm will go to zero. So one of them died. Just give you just an example. Doesn't mean that I invest in US. But if you have gotten Apple at that, then you have made a lot of money. So one of them was, both of them are totally because of some business or whatever, they are really, selling at a huge discount. So some of these will be casualty. So if you are an accountant by training or you have some financial training, that will help you a bit. You are able to sieve out some of these bad cases before it happens. But generally, it's a law of large numbers. Okay, maybe another example I give you. Just say, yeah. Okay, okay. So what he's asking is that, what happens if the stock market crashes, there's a war, and all these numbers will be invalidated. But actually, the truth is that this method works for long periods of time. That's why I show you the test for 20, 30 years. And Tae Hui Ling did the test from 1990 to now, 2012. We have suffered a lot of things. We have gone through SARS, we have gone through 9/11, we have gone through Lehman crisis. We have gone through even the worst one, the Asian financial crisis. But that simple strategy of buying cheap, undervalued stocks, holding it, and refreshing it every year yields the 14.6%. So I think if we want to make 14.6%, it requires some, not so easy. I mean, you have to, when the market plunges or when the market crashes, you have to tell yourself that, this one will work out in the long term because it has done so for the last 20 over years. So it's a bit based on faith in the numbers. But I will not say it's completely faith, because if you understand balance sheet and all that, even when the businesses dives and all that, if you study the balance sheet, you know that the balance sheet generally on a portfolio basis, it will strengthen from year to year because, they will add in their retained earnings and all that. So it strengthens over the year. So the price is actually, just say during the Asian crisis, you can tell yourself that the price is a figment of your own imagination, that the market didn't crash. So, yeah. Okay, you ask, do I focus on the price getting too low, is it? No. Based on this, you see, what I presented to you is a statistical study. Your implementation might be different. So if you ask me, the statistical study, do they don't buy stocks that are too low in the price? The answer is no, they will still buy it. And the second one is, when do you rebalance or refresh your portfolio? Based on a study, you do it every year. That is a statistical study. Based on a study, you do it every year. Okay, the studies show, based on US market, I have others, Japan market, Singapore market, Hong Kong market. We do some of these tests ourselves. But our own fund, we invest in Asia. So it's diversified across Asia. Yeah, if you're asking about the fund, yes. We will buy things which meet our criteria, which means cheap by value standards. Yes. Yeah. Yeah, I understand your point. What he's saying is that if you have so many stocks, how are you going to keep track of them? And probably you will make some mistakes. But like I told you, the opposite is to move towards the Warren Buffett approach, where you really understand the company. But I do not advocate that because it's very hard. Okay, let me tell you one story. Last time in Hong Kong, we invested in a company called KTP during my Warren Buffett days. So the company makes basketball shoes. So if you remember 10, 15 years ago, basketball shoes are very high tech. So they are the best maker of basketball shoes. And one pair of basketball shoes costs $300. So they make it for all the global brands, Reebok, Adidas, and so on and so forth. So it was a PE of 5, dividend was 5-6%. There's cash in the balance sheet. So everything looks good. It's a value stock. So if you allocate heavily, what happened to this company was, even though we know management, we talk to them, but suddenly there was a drop in orders of these basketball shoes because the fashion has changed. They prefer Converse shoes, which is made of canvas, and is a lot cheaper, and there's no technology to make. So the whole plant, because of a fashion change, it has to close, That's one example. Another example is, again, we invested in a eyewear company that make spectacles. So they are really good, very advanced. Management is, very on the ball. They were earning like 20% ROEs. So they make titanium frames, So what happened, there was a change of fashion. Nobody likes titanium frames anymore. They prefer plastic frames during a certain period. Then again, you have this problem. So what I'm saying is that it's very hard to predict where the problem is going to come from. You can't see it, So unless you are Warren Buffett, then you can see it. But if you know that you are normal, you got your family, you got your kids, you need to watch some entertainment in the evening, then it's very hard to do that kind of Warren Buffett approach. It's very hard. Then also the psyche. I mean, Warren Buffett is a billionaire, but he do something that nobody can do. He's a billionaire. If we are billionaires, we can't do this, I tell you what he can't do. What we can't do and what he can do. He's a billionaire. He spent all his time looking at stocks, right? So we think that we are him. But even after he became a billionaire, I think most of you know that he stayed in the same house and he drives the same old car. So this shows you how focused he is. How many of us can do that? Maybe most people, after they make the money, they will build a bungalow, drive a Ferrari, and all that. Then how to be Warren Buffett? You cannot. You can't even live his lifestyle in the first place. Any question?
You told us a lot about your buying principles. Can you talk about the
Sell principles is, if you look at the study, basically they sell everything after 1 year. They refresh the portfolio. So that is the study sell principle. For us, it's a bit different. So when the stock goes up, we'll check the story, check the balance sheet, check whether is it overvalued. If it's overvalued, then we will sell it. So it's a bit of a hocus-pocus investing. It's an art form, right? But if you follow the scientific form, it means that you need to refresh your portfolio every year.
So it means that you do calculate the intrinsic value of the stock.
No, the intrinsic value is you are talking about the discounted cash flow, right?
Any value, just you buying based on balance sheet.
Yeah, yeah. You track the usual stuff. You can track the PE, the yields, the price to book, and also you look at the operating cash flow in the balance sheet. Yeah, maybe I think if it's too technical or too boring, maybe some of you had enough already. I think you can, feel free to, to leave. But those who are interested, I think you can still continue staying behind. Yeah. Okay, the approach, both approaches will work. You have to craft the approach for yourself. Both approaches are okay. So you can add in the dividend yield, the PE, the price to book, the price to cash flow. These are so-called common sense indicators, common value indicators. It makes sense, so you can use any of it. You can combine your own.
Sorry, just a quick one. For those who really need to leave, you can go. But those who need to ask questions will be around. We'll stay back for a while more. But essentially, we do create a lot of criteria for ourselves before we buy the stocks. We have our own screeners.
Okay, maybe I tell you what I do. Then after that, you can construct your own simplified form. So what we do is, number one, your stock idea must be independently generated. So don't listen to your broker, don't listen to your friend, don't listen to your neighbor, don't listen to anybody. Just do yourself. So what you do by stock screener is that you got to learn it. You have to find some tools that will generate the low PE stocks, the high dividend stocks. Then you pick those that you like. So that is very important, the independent idea generation. Whereas for us, it's different because we are looking at more than 10,000 stocks. So we develop systems to score them. So the system will score them based on dividends, cash flow, and all that, and other factors. So after we have the score, we will sort it, and we will look at it one by one. So it's very process-driven. It's not driven by my mood or whatever. So when you develop your process, it has to be like that. I find that most investors, the stock ideas come from, the danger is where the stock ideas come from. It comes from the papers, come from seminars, it can come from, so stock ideas that come from these kind of places are it's already dangerous, it's already fairly valued. So you will not make money by following other people's stock ideas. You must generate your own in an impartial way. Okay, maybe I just, yeah. Okay, when I say fully invested means that, again, based on those studies, it means that all the money is inside already. So you just use the money to buy those stocks that meet your criteria. Every year, you refresh it. If you have extra money, you add it in. So you don't take in, take out, take in, take out. It just stay there, like a bank account that grow at 15%. That's the whole idea. Yeah, it's just too bad. You just see and just tell that all the people are crazy. They are throwing the stocks and the market is very low. That there's nothing wrong with your investment. Those guys are crazy. You see, one thing is that if you look at the crashes in 2008, 1997, the rebound was very strong. As a matter of fact, after 2 years, sometimes even after 1 year, the rebound, it crashes, then you cut loss, then you rebound back to almost where you started. So don't get into this game. I know it's very hard. It took me, you really have to understand the study that you stay invested and you get your 15%. You really have to understand, because once you start going in, going out, going in, going out, then you will not get this return. That's the problem. It sounds quite hardcore. No. I know there's a lot of debate. Some people will keep 5%, 10%. For me, I personally, I don't. But for the fund, when we manage your investor money, we don't take everything. They will sure keep some in extra. So I think we leave it to them. Whatever that we are given, we just use it to buy the undervalued stocks. We won't play a fool with going in and out, going in and out. We will just stay invested. Except that when markets are very high, just now I was asked one question, when markets are very high, you will find that it's overvalued. You may trim some of the stocks, and you may hold some cash, and you may hold it if there's nothing better to buy. So that is an art form. Like I told you, that is a hocus pocus form. The science form is no, you stay invested. Very good question. This is, he asked how many years before you can see result. So the answer is, after 2 to 3 years, you will definitely beat the index. Then you will feel very encouraged. After 5 years, right, you will have a very nice positive return. It can double, it can put on 50%. So you have to stick with it for a while.
Sorry, maybe a last question before we end the night?
I mean, if this investment technique works, then CPF should be paying us more than 4%. Really, I mean it in all honesty, because 15% versus 4% is a big differential.
You see,
That technique actually works over the long term, so there's more yield by going by this.
currently we are serving only accredited. So we intend to grow to a certain size, then we offer this to CPF. But it's very hard when you are managing billions. If your fund size is billions, it's very hard to put this to work. This one only work when you are the small investor like us, like yourself, you do it for yourself, then you can take advantage of this. But if you are big, I think it is harder. But if you are big and you use this same process, just say you are a billionaire and you use this same process, then that means a lot of the smaller caps will evade you. You will go into the mid caps. So I think even a 10% return by tweaking the strategy for large amounts is possible. So you are right, the 4% is low. I mean, just by constructing a portfolio, your dividend yield is already 4%. So meaning that they feed you the dividend yield, but they makan the upside.
All right. Thank you very much for attending this evening's seminar.